So will earnings continue to keep the rally going? Let's ask Tim Seymour, CIO of Seymour Asset Management and a CNBC contributor. Tim.
Hey, John.
We need good earnings to keep the market going at these valuations. Is this enough? Is this encouraging?
Well, what we're hearing from industrial companies, and take GE, take GM, take 3M, I mean, the companies are controlling what they can control. And what's, I think, notable about this earnings season is that the margin profile, definitely the earnings resiliency is really there. I mean, GM, this is a company that no one ever seems to believe they're running this company differently. I'm long GM, so I'm thrilled to see it. I'm not surprised to see it. So suddenly you have the out year that's being pushed up after a 25% beat to consensus. That in the industrial space is kind of what's going on. And of course, all we've really been talking about is AI and the infrastructure build out. So it's nice to see the industrial companies who eventually are the beneficiaries of this actually showing margin accretion now.
Well, when I think about GM and the like, I think about, boy, that contract from the United Auto Workers and then these tariffs, so much on the cost side at a time when EVs out of China, there seemed to be a lot of competition, perhaps capping what they can charge at the top end. What's the way for them to get around that?
Well, I think they're showing that, first of all, they have some pricing power, that they are eating some piece of the margin. I think the market, much in the same way that they were punished on the headlines, and we still don't really even know where a lot of this settles through. And we've seen that GM is, much in the way that I think this president likes to find the companies that are seen as the American, national champion companies. GM's one of them. And whether it's in battery, partnership and rare earths as they affect the auto industry, I think GM is in a position where, if anything, they get a multiple enhancement from that relationship with what's going on with the uncertainty. And again, back to their core operations have never been more efficient. And I think the focus on the parts of the business, the regions, they've cut out regions that no longer make sense. 7 times, less than 7 times trailing, and probably will look close to under 8 times on a forward basis after the analyst community follow through here.
How do you feel about outside the U.S.? I mean, if you look at the all-country world index, ex-U.S., been doing pretty well. We're talking about Europe again this year after the stock action there had been pretty moribund for a while. Does that continue to have legs? Any particular countries you're watching?
Yeah, I think it does. And so I definitely like it. I'm managing an international ETF, IDEVO. This is focused on, MSCI All World, but to the extent that you can lean into places where we actually think there are opportunities, and whether that has been gold mining or nuclear, but in different parts of the world, where there are parts of the China tech that make sense. But, what we've seen out of Japan over the last couple of days, the story in Japan is interesting because, again, here's a place where you have mega cap core tech companies and certainly an industrial power looking to maybe be more aligned with the U.S., but you have trading 30% cheap to U.S. Cheap has never been a reason to go out and buy international, but I think we're in an environment here where the margin profile, the fact that some of these companies are in some of the same strategic industries but are very focused on tech. We're overweight Japan and IDEVO. I like the Japanese banks. I think if the yen next week doesn't rally too much on a BOJ indicating either, I don't think they're going to hike next week, but I think they could hike before the end of the year. And I think that would be something that would be an issue for exporters in Japan. Like Japan, like Europe, I think European banks look interesting here too.
Gold. What do you like better, the metal or the miners, and why?
If gold's running, you want the miners, but much in the same way we saw gold react today to just overbought conditions, miners are going to also, we see the beta on the way up is about 2 times. On the way down, it's probably 3.5 after the kind of move we've had. Today, you don't run from the gold trade today. And I've been investing in gold for 20 years. So this is my view. I think we're going to have 6,000 gold. I think we're going to have 7,000 gold as we get out to 2030. I think the dynamics that are not just de-dollarization, it's an asset class. And if you look at the PGMs across the group, it's not just gold. Look at the move. And it's not just silver. Look at platinum. Look at palladium. So I think it's a dynamic of all the macro, some of the uncertainty. I think it's purely an asset class story. Institutions are investing in gold in a way they never have. It's not just the Chinese central bank, even though they've had a lot to do with this.